One of the many benefits of being a Motz Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the halftime report is Melissa Motz, president of Motz Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on July 29, 2015.
So welcome. Thanks for coming here. Almost the end of July. Do you believe it? Geez, just August left for the summer, and here we are again. Yeah, thank you everyone for coming out. Our next event, client event, is a conference call, December 28th. So that's a great way to get an update, economic update on the conditions that are affecting your portfolio positions. And if you're interested in introducing us to someone who wasn't able to make this meeting, just let us know. We can do a lunch, a dinner, something informal. It's no pressure. And then in a few weeks, we'll be sending you an email with a recording of my portion of tonight's event. So if anybody that you know is interested in working with us, just forward it on to them. We've got a little quote here to start. Expect the unexpected. Shows a thoroughly modern intellect. So we got a lot of unexpected things happening all the time, right? Okay, so just a couple little questions for this past year. Who delivered their last monologue as the co-host of the Golden Globes? Out of those people up there, Amy Poehler and Tina Fey, or James Franco and Anne Hathaway, Kristen Chenoweth and Alan Cumming, or Jon Stewart and Stephen Colbert? The ones have it. Yeah, they got a little trouble for referring to North Korea and the Sony that wouldn't release that movie. Remember that, the interview? Yeah, they weren't not too happy about that. Okay, which popular television series is signing off after a final season? Parks and Recreation, Mad Men, Late Show with David Letterman, or all of the above? All of the above, that's right. It's the end for all of them. Okay, and this is one I'm not really familiar with, NCAA basketball, but what rule changed for men's basketball? 60-second shot clock, more timeouts. The arc underneath the basket will extend 4 feet instead of 3. Number 3, that's right. I think it's interesting. They want to increase scoring, speed up play, and reduce collisions. So that'll be interesting to see how that goes. Yeah. All right, now we get to the graphs, all the fun stuff. What I wanted to point out here, as you can see, this is our S&P 500 index. And here we are, 2015. Here we are. And up there near the top, it's just kind of like fuzzy, up and down, up and down, up and down, not really moving too much. But you can also see right about here, we moved past our last high. And we've kept on going. Okay? It's not a straight line like this line shows. It's up and down, up and down, up and down, up and down. And we're definitely seeing a lot of that this year. A lot of volatility. Going from losing money to making money, just losing to making, for the year. It's just very up and down. And one of the things I wanted to point out about this was that we are in bull market territory right here. Okay? We didn't pull back down like here was 2000 to 2002. Then we'd spent all these years just getting back up to where we were in 2000. And then we all remember 2008 into 2009. And then a lot of time, to get back up into the fall of 2013. And then since then, we've been up. By my account, I believe we're in a new secular bull market. We'll just see gains, for a while. And I'll show you a slide later that kind of talks about that a little bit. This slide shows, it's probably hard to see from where you're sitting, but the way stocks are valued has to do with their price. Their price is based on their earnings. So one way to evaluate, are we too high? Is there a bubble? What's going on here? Is we look at the price divided by the earnings. And right now, it's, or at the end of June, it was 16.4 times earnings. That was the average for all the S&P, all the 500 companies in the S&P, the largest 500 companies in the US. And the average for the last 25 years is 15.7. So we're above the average, but we're only 4.5% above the average. Not much. You know, and remember, average is an average, so there's a lot above that and there's below that. So we're not, you know, from that measurement in you know, the territory where we really have to be super concerned. This slide that goes over corporate profits. If you look here, you can see the graph, the bar graph declined. So here we were, you know, 2012, 2013, 2014, and then boom, the fourth quarter of 2014 went down, the first quarter of 2015 went down. But the expectation is we're going to see improving earnings again. Okay, so earnings were declining. They were still there, you know, we're not saying companies were losing money, just their earnings were not growing as quickly, but they're expected to be growing again. Yeah, so we've got that going on. Also, the other thing that I think is important or worth noting, this is leverage. So up here, this was like around 2007, before things went really, you know, went down. This is leverage. So this is how levered companies are. This is how much debt they have compared with their value of their company. Very low. That's also a very good sign. You know, companies do not owe as much money compared with the value of their companies. Then for this slide, what I wanted to just kind of give a sense to is, here's the first quarter of 2014. So on the average, companies were earning $27.32 a share for the S&P 500 companies, if you average them all together. Here's what the earnings were the first quarter of 2015, $25.81 a share. So they're still earning, but the earnings went down. Okay, so it kind of relates to that last slide. Why did they go down? Okay, what makes up that number? So the change, this big red one here, $3.55 decline from the $27.32 is energy companies. So there are energy companies in the S&P 500. And we all know what's happened with oil and so forth. So the first quarter of 2014 last year, oil prices were very high. You know, last year, pretty much close to this time is when they hit their high. And then they started to decline. So of course, first quarter of this year, they were much lower, so their earnings impacted. So we can see financial companies had growth in earnings. Healthcare had growth. Industrials, consumer discretionary, information technology, any of the green ones here, telecom, utilities, they all had growth. But energy's drag on earnings has pulled down it for everybody, okay, pulled down the average. And this is a slide I always like to show just to keep things in perspective. Despite average intra-year drops, so this is going back to 1980, so intra-year, meaning within the year from January 1st to December 31st, there have been drops averaging 14.2%. The annual returns are positive in 27 out of 35 years. So if you see these red dots here, that's how far down the stock market, the S&P 500, went down in that year. But it ended up, so like for instance, if we look at this year right here, it was down 19%. This was in the 90s. It ended up 27% for the year. So this is in more recent history. Here we are in 2011. It was down 19%, ended up break even for the year, 0. So, you know, volatility or coming down in price, these, you know, corrections that happen are not unusual. They happen pretty much every year. But, you know, again, 27 out of 35 years have been positive returns. So, you know, it's you know, when you look at the day-to-day and the small little gyrations, you can get yourself anxious. But when you kind of spread it out and look at it over time, it's just part of the way it works. And what I want to show here, which I think is, you know, important because, you know, the Federal Reserve is going to be raising interest rates. At least that's what they're saying. They said that again today. They made their announcement at 2 o'clock. And the markets are always kind of waiting to see what's going to happen. And that means all the markets. Well, what this is a scatter graph. Yeah. And what we're showing here, these are interest rates for the 10-year treasuries. When the yield is below 5%, that's what this dotted line is right here. It's at 5%. When they're yielding less than 5% and interest rates go up, the S&P 500 goes up. Okay? And that's the environment we're in now. Okay? When interest rates have been above 5% and they go up, stocks go down. Okay, so you hear that, you think, oh, if interest rates, stocks are going to go down. You know, there's all this going on, gyrations, but this is pretty much how it's been. So stocks, and I'll show you what happens to bonds when interest rates go up. So stocks actually weather it much better, you know, than bonds. Another positive is this top one, corporate cash. So cash of companies as a percentage of their current or really short-term assets. It's the highest. It's at the highest it's ever been. So companies are in really good shape. You know, here's 2007. See, they was much lower. It's much, much higher now. And that's even after they're increasing dividends. They're increasing buybacks, you know. So there's still really a lot of cash that companies have, you know. So it's not a bad thing. You know, it's actually a good position to be in. So if we do have a downturn, you know, companies can weather it much better. You know, they've spent time paying down debt and so forth, you know, in this recovery that we've had. All right, so this is a much longer term view of the stock market. It goes back to 1900. I mean, this time, essentially up till about the Second World War, you know, we were still kind of a third world country, really, then. And our stock market pretty much didn't go anywhere for 30 years. That's considered a bear market. Then we had the Roaring 20s. That would be a bull market. And we had the Great Depression. And it didn't actually come back up to that point again until, you know, until the 50s. And then we were on a pretty nice bull run for a number of years here. And then we had stagflation. This is in the 60s into the 70s, the oil crises and so forth. And then we had another prolonged bull market, lots of expansion. And then we had our last, you know, really would be 13 years. Now we're in this would be another bear market where we're just trying to get back to where we started. That's the way these all work, just trying to get back to where you started. And then a nice next bull market, long secular bull market happened here. So even though things went down in 2000 to 2002 and in 2008 and 9, still didn't get back down. We haven't seen any of these numbers. These are gone. You know, we're doing much better than we were back then. So that's what we've been waiting for, another secular bull market. You know, where for a number of years, we have expansion and companies doing well. So, and that doesn't mean like in between we'll have some down years, but over the long term, you know, that seems to be where we are now. Well, emerging markets, you know, just trying to think. You know, I don't know that I can answer your question specifically as to what all affected this. I mean, I know that part of what affected, some big parts were demographics. Okay, so the vast, big population in high spending years, you know, raising their families and so forth, spending a lot of money, just a lot of people in the United States. And also productivity. You know, over this time period, this is when, you know, computers came into being and when things started, technology, you know, robotics, etc. So productivity, meaning we could produce as a country and companies could produce more with less input. So I think those were the main drivers, you know, in my opinion. But, you know, internationally, you know, I'm sure it affected it also. And I'll go over that in a slide too, about like what percentage of our company's revenue in the U.S. here is coming from international sources versus domestic. Does that answer your question somewhat?
Yes.
Okay. Yeah, we'll talk a little bit about international too. Consumer finances. Okay, so this one, I just wanted to highlight household net worth. This right here. You just can see, if you can't see the numbers, you can see the graph. The gray, highest ever. You know, I mean, that is like all the households in the United States. You know, doing really well. Doing really well. You know, we're just getting wealthier and wealthier as a country, you know, and in the world, you know, also. Now, it's not evenly divided, of course, we know that. That's not how it works. But yeah, looking good. Looking good. And then this is kind of what I was just talking about, Frank, with your question about, where the growth came from. Here we have drivers of our gross domestic product. So gross domestic product is equal to, like if the United States was a country, what we're producing and the value of our country and our economy. So you can see here in the 80s and 90s into the 2000s, we had growth in workers, represents this green, and growth in real output per worker, that's productivity, is the gray. So now here we are, since 2005, our productivity has gone down and the number of workers, growth, is going down. So, when you look at that, unless productivity can change, or if we, there's a lot of controversy about immigration and so forth, unless we can bring in new workers, we know how many kids there are at certain ages, when they're going to be, entering the workforce and so forth. That's already a given. So unless we have some really major changes in productivity, we're going to be in for a long time of slow growth, lower growth. It's going to be lower. Because this is what makes up GDP. So we're not going to have, higher these higher numbers. This graph is, what this basically is showing is that wage growth, not much. It's negative. Okay, and you say, well, how could our, that other slide show where, households in the United States are worth more than they've ever been worth, but yet wage growth is down. It's negative. We have a lot more households. This is actually keeping inflation down. So, we don't, the stock market's gone up, the value of the stock market's gone up, but, wages have not kept up with that. So there's more company profits, essentially. They're paying workers less, making more money, stock prices go up. Okay, inflation. That's always a big, a big deal, at least for the Federal Reserve. And inflation, the headline was 0% change versus the year before. So inflation is staying muted. And that's mostly because of energy. Energy prices haven't come down so much from May a year ago. That affects everything. That affects everything that gets transported, as well as, the cars we drive, the fuel that goes into airplanes and ships and, and trucks and so on. And then interest rates, just to, say, interest rates are a combination of inflation, as well as the cost of money. So inflation, as long as it's going to be low, interest rates are going to stay low. That's something else to keep in mind. They're going to stay low unless inflation picks up. The Fed and interest rates. Oh, okay. So what I wanted to show you here, this bar here, this little green bar that's going up faster, that's what it's called the Federal Open Market Committee. They are estimating when rates are going to go up, when the Fed is going to raise rates. Over here, this other line, which is at a lower rate, is the consensus of economists as to what the rates will be. So the economists think they're not going to go up as fast or as high as the Federal Reserve thinks they're going to go. So it's a big question, and it affects a lot of things. What happens with the interest rates. What the Fed was saying was that by the end of 2015, the Fed funds rate would be an average of 0.63%. Right now, it's still 0.13. It hasn't gone up. And today they met. They did not raise rates. So probably it could be September, October, November. We'll see. And then, of course, everybody's waiting to see how it's going to affect the financial markets. And then this slide, which is a busy slide, but what I wanted to show you here was the impact of an increase. And this is based on, a 1% rise or fall in interest rates. So this is 2-year U.S. Treasury, 5-year, these are inflation bonds, 10-year U.S. Treasuries, and 30-year U.S. Treasuries. So if interest rates go up 1%, U.S. Treasuries, the value of the Treasury bonds will go down 17%. Okay? And we saw this in the second quarter. 30-year Treasuries went down over 10% in that quarter because interest rates went up. So the longer out, the farther out, 30-year, you can see you have more of a dramatic effect And then the other way, if interest rates fall, here's the increase. The increase in 30-year would be 22.8%. For 10-year U.S. Treasuries, 9.5. So it's something that we're balancing, and the managers we use in the fixed income portfolios are managing. So these types of investments in income producing, floating rate, very little effect, you can see there. So we have some floating rate in your investments, okay, because we're anticipating rates are going to finally start going up based on what the Federal Reserve has said. Convertible bonds, they convert from bonds into stocks. They're not affected as much. High yield, they're not as affected as much. So, and we can see here, corporate bonds are affected, a fair amount by the change in interest rates. So we've got some more things in this area to try to mitigate the effects of rising interest rates. And this is our international, the MSCI EAFE. Basically what that is that's Europe and Asia, the larger economies, Australia, etc., Canada, but not US in here. Up through June, this is where it was, the end of June. Here's the high back in 2007. So international markets have not yet exceeded the last high like the US markets have. So, the fact that the European Union, the European Central Bank, they are in a mode of easing, meaning making more money, putting more money out there. There's the general consensus that European economies will start to do better. Same thing, Bank of Japan is doing it. China also. So the consensus is that those companies that are located in those other countries should start to do well, and they should catch up with the U.S. because the U.S. has exceeded our. So we do have some international investments in your portfolio, as well. That's pretty much everything I wanted to go over. Any questions on anything before I turn it over to our friends at Steadfast? No? So the consensus, the way I leave it is, I'm still positive on the markets. I think, we'll get through this volatile time just like we always do, and I think we still have, ways to go in the up direction. So thanks everyone for coming. Great.
I hope you enjoyed listening to Melissa Motz, and if you have a friend or a relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motzwealthmanagement.com for the most up-to-date listing of these events. Over the years, many of our clients have asked Melissa to speak with a friend, relative, or colleague concerning private financial management. Melissa considers it an honor and a privilege, and has been happy to accommodate those wishes. For your future reference, please be aware of the standards by which she complies with such requests. First, confidentiality is the cornerstone of our business. Each of our client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, Melissa will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send Melissa an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, FINRA, SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.